Okay, good afternoon, everybody. For those of you who don't know me, my name is Cassandra Fortier. I am a mortgage advisor at Meta Mortgage Group. I am joined today with our principal broker, Vince Scarselli.
Hey everyone, hey Cass.
Hey Vince, how's it going?
Good. How are
Everyone,
you?
everyone good at the office over there?
They miss you actually. Cordia thought you were coming in today, so she made me say to you, you know what? Tell Cass that I'm really disappointed she's not here with us today.
Maybe I'll come back for a coffee after this.
All right, let's do it.
Perfect. Well, the reason I wanted to hold this call today, I'm sure many of you who are watching are thinking about this right now, just with everything in the media. But I know myself, as well as our other mortgage advisors and the mortgage agents that work with us, we're getting a lot of calls right now about the recent interest rate rises with the Bank of Canada lending rates increasing. A lot of people have concerns, so I wanted to just discuss openly kind of what is everybody asking and what are we telling them.
Perfect.
So first off, Vince, let's start by talking about what the announcement was, the most recent announcement, and why it was so surprising.
Well, I mean, everybody, from what we know anyways, kind of knew there was going to be an increase. I mean, we've been feeling these increases for the last 4 to 5 months. Never before have we seen, obviously, where these increases have happened so quickly. So it's catching a lot of people by surprise. What caught me by surprise was the fact that we really thought the Bank of Canada was only going to increase rates by 3/4 of a point, which is in and of itself a lot.
And that works out to 3/4 of a point, right? Like 3/4 of a percentage.
Yeah, so 0.75% is what we thought it was going to increase and follow the Fed in the US. But instead, what happened was they increased it by 1%. So a nice clean 1%.
Yeah. So when the Bank of Canada does that, how does that trickle down to the end user?
Good question. So basically what it does is it makes the banks sort of get together and decide, because we don't like to say that we have some collusion at the bank level, but we all do. They're all the same table.
Vince, right? Careful. We don't want this video taken down.
Don't censor me, please. So basically, they all sit down and go, okay, well, what are we going to do? How is this going to impact the borrowing rate? And the main borrowing rate is prime. And the prime lending rate is what is traditionally known as what is offered to prime borrowers or their best borrowers, which is basically your cash rate, the rate that you can borrow on something like a line of credit on demand. Okay, and the biggest impact for clients today is on a variable rate mortgage products and secured lines of credit. So the prime lending rate essentially went from 3.7% up 1%. So whatever the Bank of Canada raised, the bank passes it on to us as borrowers and makes the prime lending rate increase by the same amount of 1%.
That's right. So what does that mean for somebody who currently has a variable rate?
Variable rate mortgage. So basically what that means is
sorry, maybe we should go back. How is a variable rate calculated, right? Because a lot of people don't even know that. So maybe we should explain that first.
Great. So yeah, I would hope that our clients know how a variable rate is calculated, but knowing that maybe there's going to be other people, hopefully other people reading this or watching this are going to know that variable rates are calculated differently than fixed. So your variable rate starts off from prime. So again, that same prime lending rate of currently now 4.7%. And typically in a variable rate mortgage that has a closed term, you would then have a discount off of prime. So let's just say it's easy, prime minus 1%. That would mean that your net rate, the rate you're paying, is 3.7%, right? From 4.7. So that would mean that prior to this increase, if prime was 3.7% and you apply that same discount, the client's net rate was 2.7%. So you can imagine these are increases that clients are feeling. Right, Cass? I'm sure you're getting these calls as well.
Yeah. So I think then people don't necessarily know how to calculate 1% increase. What is that going to do to my payment every month? How much is my payment going to go up? I'm getting questions of people saying my rate has now doubled since when I took my mortgage out, let's say 2 years ago when rates were super low through COVID. And I've actually been surprised. A lot of people have this mentality that if their rate doubles, their interest or their payment is going to double. It's an incremental increase. It's a percentage of what you're paying, but maybe you can break down a little bit of math. If my interest rate goes up by 1%, what is that going to do to my payment?
Yeah. So that's a very good question. That's a common misconception we see with clients is double interest, which is rare. We don't see this anyways. This is very, very rare, but it's always been a fear of clients when we're talking about variable rates, when we're discussing suitability of a mortgage. One of the fears they have, and I always ask them, what's your greatest fear? What will happen with this variable? Well, what if it doubles? Well, what do you think is going to happen? Well, my payment's going to double. No, not at all, because the interest only accounts for a portion of your payment. Right, the rest is principal. So what would happen in a scenario? Very easy way of looking at it. Let's just throw some number out here. Okay, so if the mortgage is a $500,000 mortgage, right, and now we're then actually let's make it easier, $600,000 mortgage, and then you actually increase the rate by 1%. Right, that's an increase of your annual cost of borrowing. Right, so then that's essentially 1% of 600,000. Is $6,000, right? So that's essentially over the year. So if you were to take $600,000 and divide and multiply it by 1%, and then take $6,000 divided by 12 months of the year, that's a $500 payment increase, right, per month for that. Yeah. So that's why you can see there are a lot of clients that are going, "What just happened?"
Yeah.
Right, because typically we've seen an increase of 0.25% historically.
Yeah.
Most recently, we've seen 0.5% increases, which is rare enough. And now this 1% increase is the first time in over 24 years we've seen that.
That's right. So as soon as we explain that to everyone, their next question naturally, should I lock in?
Yes.
We did do a short video on what locking in means, but in case our viewers today haven't watched that video, I do recommend you go back and watch it. But I'll just give a really quick recap. So locking in, a lot of people, one feature of a variable rate mortgage is that you have the option to convert that variable rate mortgage into a fixed rate anytime during your term for the rest of your term. Now, a lot of people have this misconception that you're locking in the rate you have. So if your variable rate was, let's say 3.7 just before this last increase, a lot of people have this misconception that you can then lock in 3.7 and your rate will be 3.7 for the rest of the term of your mortgage. Unfortunately, that's not the case. Nope. Basically, what would happen if you wanted to lock in, you'd be taking whatever a comparable term left. So let's say you have 2 years left. The bank would look and see on a similar 2-year mortgage that they have right now, what is the fixed rate being offered? Now, what we're seeing right now is that rate is very different to what your variable would be. So Vince, maybe you can expand on that a little bit on switching over to fixed. What would that mean for your payment? And is that a good idea right now?
Yeah, so we're noticing that you explained it perfectly right. So basically 2 years left. Let's use that example. You have 2 years left on the mortgage. Now a client can switch into a 2-year fixed, typically, not all lenders, but let's just say most lenders will offer the 2-year fixed, 3-year, 4. Of course, it'll take you longer term if you want to sign a longer term with them, right? I mean, most banks are hoping that's what's going to happen here. But if you were to just take a 2-year term, you're going to then be offered what the discounted rate is currently on a 2-year term. Okay, so then you would be giving up that 3.7 rate currently today, and you would be accepting today's current 2-year fixed term. And that might be something like a 5.24%. I was looking at one yesterday, 5.24%. So now a client's giving up 3.7 for 5.24% at no additional cost, as the bank likes to say. Well, there's no additional cost. Well, there is additional cost. The cost is interest, right? That's the number one cost that we're going to see. So the client has to accept a higher cost of borrowing right up front for the next 2 years. Also has to accept higher payments, right? Cass, like we'll see that clients will then see a significantly higher payment. If we said on a $600,000 mortgage, an increase of 1% could mean something like a $500 payment increase a month, somewhere in that area, depending on the amortization. Now we're going from 3.7 to 5.24.
Yeah.
That's over a percentage and a half increase, right? So you can imagine you're now accepting a higher payment of which that increase is all going to interest and all going in the bank's pocket.
Right.
Okay. So something to really keep in mind when it comes to that.
The other cost of switching over to fixed. This is the one that I think really blows people away that they aren't aware of. It's when we talk about breakage penalties. So one of the big questions we always ask clients when we're pre-approving them before we put them into a mortgage is kind of what their plans are. It's all about suitability, right? So are you going to want this mortgage for 5 years? Do you think you're going to move? And in a lot of cases, because we know the average Canadian doesn't live in their house usually longer than about the 3-year mark, or will refinance within that 3 years, oftentimes a variable ends up being the best option for many of our clients just because of the flexibility of the penalty payment. When switching over to fixed, it's something we really dive deep into with our clients when they want to switch over, just because of what that penalty could mean. So maybe you can explain the interest rate differential calculation and how costly that can get.
Yeah, absolutely. I mean, that's probably the biggest reason why we discourage clients from switching. Number one, obviously, you're going to pay more interest up front, but in the back end, people never consider the back end. We see it all the time. Clients who, for example, have come to us for the first time and they've been coached into a fix, but then
kind of the default setting for a lot of people, right? Just fix,
set
it and forget it, set it and forget it, and they don't really put too much thought into it going forward. But as we can see, and we saw this a lot over COVID too, these penalties were pretty astronomical just because of the difference in rates. And
when does a set it and forget it scenario ever good? Like, let's really be honest. Like, it's never really
it's like a bad word. I don't ever want to hear someone say set it and forget it.
That's
not a smart way to manage your finances.
Do you ever set and forget your life? Like, if anybody ever says to you,
live on autopilot. Live on autopilot. That sounds fun.
Put your money aside here, and we're just going to set it and forget it. Just run away.
Yeah.
You know, run as far away as you can, because set and forget it is like it's a pipe dream, right? It's never going to really be that. There's all life happens.
But I do think a lot of people think it's the safe option because they're not well informed. So they think, oh, I'm going to just take this fixed rate. I can budget myself every month because I will know every month for the next 60 months exactly what my payment will be. I know how much I earn.
Yeah.
I know how much my payment will be. I can set my budget. I've got my leftover little nest egg at the end of the month, and I put that in my savings account, and we slowly increase this savings account. So they do think that it is the safest option, but I truly believe that that is because people are not educated on, number one, where their money is going in terms of interest, but then what happens if you need to break it. We have seen in the last 2 years, people's lives change at the drop of a dime.
Yeah. Oh yeah. I know.
We have one client who moved into her dream house twice in 18 months. So, you know, hey, are you going to live here forever? Yes, forever. It's our dream home. We're never leaving. 18 months later, she calls me and says, hey, guess what? We found our dream house.
Yeah. Boy, wasn't she happy she was in a variable at the time, right?
Yeah, it happens often. So I think that we, especially the last 2 years, teaches us that you never know what's going to happen. We need to be in control of the decisions that we make so we can make pivots that are smart based on the market, based on our employment status, based on life changes, have a baby, need a bigger house, need to renovate, need a smaller house, whatever it may be.
I mean, it's 32 degrees right now. And I mean, yesterday I was talking to a client who said, thinking about putting in a pool. And I said, well, okay, well, so it means we're going to have to refi your mortgage if you're going to want to take some, because based on the way it's structured. But she had said, yeah. And then immediately we followed this discussion about where she was right now. And luckily she's in a variable rate. So she's going to have more options to be able to do that because back to this implication of, what it means to be in a fixed or switching to a fixed and converting to a fixed. So let's take that example of a 2-year mortgage. You're not only accepting a higher degree of or higher cost of borrowing up front, but the back end is, let's go back to that back end. You are now giving up a 3 months interest penalty for the option of paying the higher of a 3 months interest penalty or interest rate differential. Now, as a very scary proposition. Why? Because interest rate differential is unpredictable and it is costly.
Can you explain in an interest rate differential situation, what rate are they using compared to your rate? This rate that people are comparing it, I think that there's a misconception about what rate is used there. So talk a little bit about posted rates.
I hate posted rates, Cass. You know that. Okay, so posted rates. And
hey, maybe if you want to get into it, why are they there?
Yeah. Well, then we'll start to get into all these conspiracies. But basically, the posted rates is this wonderful table of rates that no one ever pays. And so if you just go to a bank's website and you take a look at mortgage rates, they're going to have discounted rates and they're going to have posted rates. Okay. Now the posted rates, no one ever pays them, as I mentioned, but they are used for a purpose, and they're used for the purpose of calculating what an interest rate differential penalty would be. So example, you go from that 3.7% variable rate into a 5.24% fixed rate, and the posted rate on that 5.24% fixed rate might be something like 6%. We'll just do a round number, okay?
Yeah.
And so now what happens is that's the benchmark rate that you're going to use to calculate an interest rate differential. So if you, within those 2 years now, decide to sell the home, refinance, something happens in your life, you're like, I have to pay this mortgage off, or I have to move, or I have to sell the house, or put in a pool. I have to put in a pool. Anyways, but
wow, your kids must be bugging you because that's fresh in your mind today.
They're not getting a pool. So basically that reference point of 6% is what's being used. Even though you're paying 5.24, the bank's saying, hey, we could have charged you 6.
Yeah. Even though no one's ever paid a posted rate before, ever. we're
gonna base our calculation based on the 6 that you could have paid, because you're leaving us. So we're not gonna apply that discount anymore. Okay. Right. But what we're gonna do is we're gonna then take the reference rate of whatever term is left. So if you have less than 2 years now left on the mortgage, they're going to take a lower term posted rate, apply that discount, and create a differential.
Yeah. So let's say you've got 18 months left on the mortgage. They're going to go to the closest term that they have, which in this case would be 1 year. They're going to look at a 1 year rate and say, this is what we're offering right now for a 1 year term. They're going to take that rate, subtract it from the posted rate.
They're going to take that rate, subtract it from the posted rate. Some actually apply the discount on that lower rate that you're getting to make it larger.
Of course they are.
Yeah. Some use bond yields, which are even lower. So it does create whatever's going to create that differential.
It's a big gap.
Is going to then cause your cause the calculation to be inflated and make a larger penalty for you to leave. And essentially what the bank is saying is they're trying to recuperate the interest costs they would have got from you, or a portion of it that they would have got from you should you stay till the end, because of course they have taken on some balance sheet risk, which I agree, but not to the tune of the $20,000, $30,000, $40,000 and even excess that we've seen before. So I would say that's the one thing that a lot of clients don't think about. In that example of a $600,000 mortgage, it's not inconceivable for a client to have 2 years left on the mortgage and pay $24,000 to leave. And therefore that would essentially be like paying an additional $1,000 interest a month for the next 2 years. While you don't even have that mortgage. Exactly.
So, I think the next thing people are always asking is, or one thing that they're concluding is, we had just talked about with the fixed rates that, people think that it's the safe option. It's safe. It's predictable. I know what my payment's going to be every month.
We're frozen.
Oh, am I live? Vince, are you there? Vince, I think it's you that's frozen. Vince?
Yeah, we're frozen.
Okay, we need an image of like the technical difficulties. We'll be with you in a moment. We need one of those.
Maybe some Jeopardy sound in the background too.
Yeah, exactly. So what I was saying was, before our brief intermission there, was that a lot of people with the fix, we had just said before you explained the interest rate differential, so a lot of people pick the fix because they think it's the safe option. It's predictable because they know what they're going to pay every month.
Right.
I often kind of flip that conversation when I'm talking to my clients to explain to them that it's not predictable. And precisely for what you just said, we don't know what that interest rate differential is, because there's a few things we can't predict here. We can't predict when you're going to break your mortgage, And we can't predict what that posted rate is going to be and what that difference is going to be at the time that you break it. So at the time you're taking the mortgage, I'm not able to say, hey, listen, if you end up selling the house, your interest payment,
there's that Jeopardy sound again. We need, okay, there you go.
Your penalty is going to be roughly this. Whereas with a variable person, yeah, there might be some fluctuations throughout your term on what your payment will be. But if you ever need to get out of the mortgage, it's predictable. It's, to me, safe, because 3 months of interest, that's it, and you're out.
Absolutely. The other thing, remember, is what's never really factored in is someone who takes the penalty and pays that penalty, and it's taken out of the proceeds of the sale of their home.
They're using your equity on fees instead of on a down payment or to do those renovations or whatever.
Well, and not only that, you're then rolling it into another mortgage, and then what's happening is it just keeps compounding the cost, right? Again, those are things that are never factored in, very hard to imagine and calculate, but those are real costs that are rolled in. It's kind of like someone being in a lease and then getting a phone call from their dealer that says, hey, you got 3 months or 4 months left in the lease, let's get you in a new one. And we'll just roll the cost into the new one. We'll just roll it in. We just roll it in. Well, you keep rolling things in. At one point or another, I think everybody would love to see their mortgage erase and evaporate at some point. It'd be nice for it to be gone. Harder to do that if you keep rolling in penalties for making changes, right? Yeah. So really, really important. Those are things that people don't factor in. That's why anytime someone calls, and actually I'm just seeing the time now, we kind of got to end it off very, very soon because I got to jump on a call. But basically, same thing. Client needs to review their budget. We need to look at the suitability in the file. So of course we take detailed notes, and Cass will sit there and go, okay, like let's revisit what we talked about.
Why we did this, yeah.
Yeah, let's revisit
why we picked the mortgage for you that we did.
Yeah, and let's see, have things changed? Has your life circumstances changed? Job,
your budget changed.
Yes, your budget. What's going on with the house? Are you happy with it? Are you planning on leaving? Or is this a rental property, and are you planning on still being a landlord or not? So all these things merit a discussion. It's not just that should I flip into a fixed or not. There is no 100% Band-Aid answer. However, most times we're telling people to just maybe turn off a little bit of the news, filter the information you're receiving, look at it all, maybe sit down, let's crunch the numbers and talk about what your goals are, still revise them, and then we can provide proper advice on what to do.
Absolutely. Just before you go, I know you have another call, but the other question I get, so these are the questions that we get from our clients who are in their mortgage and trying to decide if what they are currently in is right. The other group of clients I have are people who are shopping right now. Some people call and say, hey, you pre-approved me 6 months ago, a year ago, whatever. I've been outbid a million times. I see prices coming down, but I see interest rates going up. Should I hold off until interest rates come down, or should I continue to start buying? Or is now a good time to get pre-approved and start shopping, right? What are you saying?
I say the biggest determining factor in that decision is, are you buying for the long term? Like, are you buying to live in it? Or are you buying to speculate? If it's a speculative buy, this is far too tumultuous of a market to jump in and know sort of where you're going to be and what you're going to come out with in 6 months from now if you're looking to flip it or something. But if those first-time home buyers are looking to buy a house, it always comes down to, it's the same answer it was when prices were rising.
Yeah.
Find the place that's right for you. If it means that the place that's right for you is available today, regardless of what's going on with rates and prices and everything, then move forward with it. Yeah. Because that place is home. This is not an investment in the sense of, I'm going to be out of this in a year or two. So really think about,
like, those flips are maybe a little bit more volatile right now. If you're buying something to flip it, do some work and flip it, a little more volatile and a little more unpredictable. But long-term rentals, owner-occupied homes, second homes, things that you're going to hold on for a while and let that equity build over time. There might be ebbs and flows of how much that equity is, but overall, it's going to build there for you. That's
correct. That's what I always tell people, is that we can never time the market. No one has a crystal ball. You don't have one. I don't have one. There haven't met anyone with a crystal ball as of yet that actually works. So what I would say is, get back to the fundamentals, talk about what your budget is. Does it fit your budget? Does it fit the affordability? Can we qualify? What does it look like? Is it the right home for you? And once you have your team established around your mortgage broker, your real estate agent, your lawyer, everybody involved that's there to help you make things happen for you, at the end of the day, it comes down to, is this the right place for you? And if it is.
And does it still fit your budget, right? I do have some buyers who've backed off their budget a little bit, because the one thing that we are big on in the pre-approval meeting is not so much this is what you are going to be qualified for with a lender, but what can you afford on a monthly or biweekly basis? And we work backwards from there. So we have, with the interest rates rising, we have revisited some of those pre-approvals, given people kind of a new target number, and they're definitely still out there shopping. And a lot have been successful in the last month or so, because finally, there's a little bit more inventory on the market. These people have a bit more competitive edge because they're now looking at those conditions of financing and conditions of home sold, which we haven't seen in years. So some of these people are actually getting back in there, because a lot of buyers have just decided to take a step away instead of being competition for our other new buyers. So in that way, it is kind of maybe a good time to keep your eye open on these opportunities.
Yeah, and it's a good thing. Honestly, we need to have the market normalize. When have I ever seen someone buy a house sight unseen and without any condition or understanding that, what they're getting into, and they're just buying on emotion rather than buying on the fact that this is the right place for them. So no, I'm happy from that perspective. I think we all are. So let's see.
Yeah. Last real quick question. I have a lot of people have asked me this. Do you have?
Come on in. Hold on. Who are we? Who's this? Hello, Nick. How are you?
Nick.
Say hello.
Hello. Hey, Cass.
Hey.
He's wearing some food. Look at this. My gosh. Those of you who don't know, this is Nick. Say hello to Nick.
Hi, everyone.
Nick, there's no one there right now. This is going to be posted on YouTube.
Oh, amazing.
There you go.
YouTube famous, YouTube star.
Oh, I hope so. Vince needed his lunch, so can't be hungry anymore.
Oh, wow. Look at that.
Yeah, I've had a lot of people ask me, so are you in a variable or fixed, and what are you doing?
Me?
I want to know, what are we doing with our mortgages? Your personal mortgage, what are you doing?
Way, man. Variable all the way.
Variable all the way. I think that gives people some peace too, knowing that
that's true.
We're right alongside you. We're looking at our numbers as well, making sure that things still make sense to our own plans. But I've had a few people ask me that, well, what are you going to do? So,
yeah. Or if you decide to change, make sure you call
me. Know.
Right? So I'm going to give people a margin call if I'm giving myself one. And so we laugh about that, but no, absolutely. People, what we practice, what we preach. So at the end of the day, it comes down to suitability. And quite frankly, for most people, the variable rate is the most suitable. They just don't know it because they are afraid, and I get it. So that's what we're here for.
Yeah, exactly. Well, thank you very much for your time, Vince. I'll let you get on to your other calls, and awesome. We'll chat later, and stay tuned for more information, because we're going to try to share more videos answering a lot of these questions.
This has been great. Thanks, Cass.
Okay, awesome. Thanks, guys. Bye.